Hello everyone, how's it going? So in this video, we're going to talk about ENDO International PLC. The latest news, how the market's treating it, things that we really should take on as lessons learned, and also what is the trading approach going forward. So first of all, why ENDP ENDO? I think the first reason why we're interested in that small cap company in the first place based in Ireland is because over the recent past, its stock price increased, significantly so as well. But at the same time, in my previous video, I did mention that the risk profile is quite high. So this is why we should be very careful around it and to decide, first of all, if we want to invest in ENDO, and also if we do, how much we want to put in. Speaking of which, when I type in ENDP, my video is ranked number 1. And because it's several days old, I do want to update it because things have fundamentally changed regarding the company. So in my last video, we were still at like the upward phase, right? Things were going relatively, I wouldn't say well, but I would say in an attractive manner. And a lot of people wanted in, and my analysis at the time was to say, you know what, the company has a lot of downsides, fundamentally speaking. Although from a price action perspective, there's not much, because it's a penny stock either way, right? So mechanically speaking, the downside is relatively limited. With that being said, recently, with their legal actions going on, the company declared bankruptcy. And as a result, the stock price plummeted. This bankruptcy doesn't seem to be an immediate liquidation. It seems to be they want to reorganize, they want to see who wants to take over from there onwards, and then try to revive themselves. This is, I think, their current approach. Can they really succeed? Is this, doomed to fail? At the current stage, it is too early to say. However, we can see that in the stock market, people have kind of sort of priced in the fact that it's going to survive a bankruptcy procedure, that this company will continue to exist under a different form with different shareholders, a different board, and so on, but it'll continue to exist. Maybe different buyers would come in, different people would try to take over its assets and do different business or operations with it with the same shell, the shell of which you might have bought shares in, the ENDP shares. So this is where things stand at the moment. It certainly doesn't look great, but it seems like the largest part of the storm might be behind us. 2 words about my trading approach, my personal trading approach for ENDP. I did not find a place to fit it in to my portfolio, simply because the risk profile doesn't really correspond to what I'm willing to risk, and also certainly not really an allocation to this kind of securities. Most of my products are invested in either fixed income or real estate-based investment funds, so the REITs. Some of them are in the more speculative stocks like Palantir, SoFi, and so on. And we're going to come to that in a second because it is actually relevant to talk about these as well. So long story short, I didn't have a place for ENDP in my portfolio personally, so I didn't own any of them. It's actually a good time to remind us of our approach when trading stocks. So over the past few months, and I would say years, in doing videos on YouTube, many people have told me, every time I tell people that my allocation is around 3 to 5%, or 1 to 3%, or even below 5%, I think rarely, if ever, the maximum allocation that I would recommend goes above 8%. So a lot of people said, you know what, this is really too small. Nothing is going to be gained. Nothing is going to be lost. Um, it's kind of pointless to suggest to people that you should only take, um, 1 to 3% or maximum 8% of any sort of stocks. And people have told me about it when CCIV was taking off, Nikla was taking off, Hyliion, Genius Brands, GNUS, SoFi, and of course Palantir and Endo. Because every single time when the stock takes off, the surrounding environment in which we are is very different. People talk about those stocks as if they're literally going to go off the charts, right? We cannot feel it now, but for those of you who were around ever since SoFi initially took off, you should remember how the market was treating it, right? That everybody thinks that this is going to be the future. Everybody thinks that as soon as they bought the bank license, this is it for the stock. Well, it wasn't it. And this is why I personally would say we should really be careful about owning a large chunk of any sort of specific position, especially the stocks from the NASDAQ or the tech stocks. Because from 2020 to nowadays, the market has not been in a normal state. And in 2020, we're now well into 2020, right? I would say that we're even less in a normal market. Because even if the market has retraced somewhat from where it was at its peaks, I would say that still, the prices are very high for where the economy is and for where the economic outlook is. And remember, the market is a zero-sum game. The chart that we're currently looking at and the chart of any sort of exchanges or, for example, the DAX, the NYSE, the S&P 500, they might be very high, but it's paper thin. It doesn't have billions and billions of dollars willing to take on your position when you liquidate it. It could be half that in a split second because everyone rushed to the exit. Sometimes there might not even be a market. So the order that is available to us might be surprisingly low. It hasn't happened in a while, but it definitely happened, right? So for example, in March 2020, this kind of thing, I'm 100% sure that they have happened. So anyway, my point is, when people have told me I'm risking too little for the good of the portfolio, well, it's because I never fully trusted that the amazing story around those stocks would necessarily go true, regardless how true they sounded back then, because they can also sound not true. The websites that are at one time saying this stock is covered in gold, it's covered in diamond, it's going to go up to the moon, can also start posting articles like, what happened to the stock which, by the way, we, the same website, have said it's amazing, right? They can immediately forget about this. So the good vibes around the company should never be the main component, or the main factor that motivates our investment decisions. And speaking of decisions, it's rare that I personally ever do like speculative trading positions that are like in and out. I tend to stick around like the titles that I'm in for. So, for example, an example of which I traded the stock in and out was Molen. I traded in the stock and then it jumped by, I think for me, it was 171% of my initial cost. And this is when I decided to leave. Was it a good decision? In the long term, yes. At the time, it still rose for a bit. But for me, it was a little bit too high for my own liking. in that type of time frame. So this is why I decided to not continue to stay in Mullen at the time. For Palantir and SoFi, I actually have long-term positions in them. And at some point, I think SoFi went down by like 60% or 70% in my portfolio. Did it matter significantly? Like, did it tip over the balance of my own portfolio? Actually, no. Because I owned less than 0.1% of SoFi at that time. Palantir, I have limited my exposure to around 1% for the time being. I'm open to the idea to slowly purchase over the next 24 months, but I don't want to rush in now. Like, if I missed out a huge chunk of the recovery, then, all the worse for me. But I'm not willing to put in like another 10 to 15% of the Palantir exposure just yet. And it is even less the case for ENDO. So now that we have talked about the past and I would say the present, and as well as the lessons learned, let's also address what's going to happen going forward. So as you saw, it's not all over just yet. The company hasn't been liquidated and not delisted. Now, just a quick reminder here. Everything that I'm saying here, like ENDO not being delisted, not over and everything, this could all be over the next time that we talk about this company. Okay, so I just want this fact to be out there, and that you soak in this possibility going forward. We have seen stocks recovering somewhat from a low immediately after like a major event. So for example, when Luckin Coffee got delisted, yeah, the stock price plummeted, but they have recovered somewhat ever since then. Have they recovered their former glories? Absolutely not. Will they ever recover it? You know what? Maybe, but they have to change their exchange. Like, they have to be relisted somewhat on there. What else? Nikola. Did Trevor almost crash Nikola? Yes. Did it recover somewhat since then? Yes, but like certainly not enough for me to get back into Nikola or to ever enter into Nikola at all, actually. So yes, things can still happen afterward. It's not the end-all be-all. Another example was in 2008, when AIG almost went bankrupt. I think they went to single digits before slowly recovering back, ever to like the mid-50s, if I remember correctly, before taking another dump because of March 2020. And ever since then, I haven't really checked, but I think that it's still higher than where things were back then. It's not a very high bar, I admit, but all I'm saying is sometimes these kinds of major events can be the sign of a slow grind, of a slow recovery upward. So if we look at the current price level, the risk of the downside is relatively low, very low in fact. I think that the market has priced in the fact that ENDO has taken a huge hit and the worst might be behind them. This is my interpretation of what's going on at the moment. Can things change over the next couple of days and weeks? Probably. But here's the thing. I don't actually recommend getting into ENDO at the moment because I don't know if what I just said here is 100% priced in. Okay, I'm not 100% sure that the market believes that ENDO is now safe and it's just going to recover somewhat from like a takeover or whatever. It's possible that over the next couple of days, the market will decide, well, you know what? We don't really trust this recovery. We don't really trust that the company can get back from here. I'm going to cash out my chips at a loss. Huge loss, maybe. But I'm out. So it's possible that over the next couple of days, things are still going to move. But here's the thing. if over the next, I would say, 5 to 10 business days, ENDO remains at the current level, then we can safely conclude, in my opinion, that ENDO is not going any lower, at least in the short term, and it will have the capacity to mechanically recover because the number of people dumping it will slowly decrease over time, and the number of people, oh, you know what, I'm just throwing in a couple bucks to test my luck, that kind of people will slowly increase over time as well. And I would say another good sign is that the institutional owners haven't moved just yet. So according to Fintel, I think they're above 61% of institutional owners who own ENDO still at this moment. We might see a different number next time the report refreshes, but for now, it's still around 61%. And also, like, the short positions are currently around, I would say, 15 to 16%, which is significant, but not unheard of in this current scenario. And frankly, I would say that if people were to short the stock now, it's a pretty bad move, right? Because it's already so low. How much lower can it get? Unless the company declares bankruptcy. So I'm not a big fan of shorting any stock to begin with. But in this case, I would say, first of all, don't ever short ENDO. And second of all, that might be another reason to buy the stock in the short to medium term. Because it's possible that the people who have shorted ENDO realize that, this is not the best decision of their life. So they want to cash out to avoid paying, financial costs day after day. So this can be another potential reason to get into ENDO. Now, keep in mind that the risk profile of this company is high or very high. So you should definitely have a diversified portfolio before getting in the stock. And you should be ready for the scenario that it may not survive this whole episode of bankruptcy. It might actually just get liquidated and delisted. So that is my overall approach. If you want to buy, now might be a good time to start looking at it. See if things can stabilize around this current level, then put in like a portion of your portfolio that you can do without. So is it 1%? Is it 0.1%? Is it 5%? That is up to you. But I personally wouldn't go above 5. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.